This is an Uncovered Japan Company research report on Nippon Express Holdings, ticker 9147. It is Japan's largest logistics group and roughly the world's fifth largest freight forwarder, operating through a self-run network across sea, air, road, and warehousing. The key question is whether a real earnings recovery can justify the valuation already embedded in the shares. At the report date, Nippon Express had a market capitalization of about 1.36 trillion yen, with overseas operations contributing roughly 44% of sales. Its forward price-to-earnings multiple was 22.6 times, while expected return on equity for fiscal 2026 was 7.3%. Those figures frame the central tension. Scale and liquidity are strong, but the market is already pricing in a substantial recovery. For a customer, the product is not simply a truck or a warehouse. Nippon Express coordinates cargo across ocean freight, air freight, road transport, and distribution facilities, often using its own global network. That creates a meaningful advantage where a shipment is complex, regulated, or time-sensitive, such as pharmaceuticals and heavy haulage. In basic forwarding, however, the service is more commoditized, so sheer size does not automatically translate into premium margins. The segment mix shows why Nippon Express is a genuine logistics franchise rather than a narrow forwarding business. Japan Logistics is the largest profit pool, alongside operations across the Americas, Europe, East Asia, and South Asia and Oceania. The group also has specialist businesses, including heavy haulage and construction, where margins are higher. The trade-off is that the broad footprint is operationally demanding, and Europe has already exposed the cost of weak execution. The operating record is clearly cyclical. Revenue has remained roughly around 2.5 to 2.6 trillion yen through the last 5 years, but operating profit fell from 155.5 billion yen at the freight boom peak in fiscal 2022 to 49.1 billion yen in fiscal 2024. Management guides to 100 billion yen for fiscal 2026. That is a material rebound, but still short of the peak that established the market's expectations. Fiscal 2025 illustrates why headline earnings need interpretation. Operating profit edged up to 51.5 billion yen, yet net income fell to just 2.7 billion yen. The report attributes the collapse mainly to a European goodwill impairment and an unusually high effective tax rate, rather than a sudden failure of the operating business. Still, the underlying business margin was only 2.6%, leaving little room for error in a cyclical logistics market. Cash flow offers a more stable view of the franchise. Operating cash flow has stayed around 200 billion yen, and free cash flow rebounded to 205.5 billion yen in fiscal 2025. That rebound included 105 billion yen of asset sales, so it should not be treated as a pure run rate. Even so, the cash profile is more resilient than the one-off hit to net income, and it helps explain why the company could maintain its dividend. The moat is real, but uneven. NX benefits from a self-operated global network, long relationships with blue-chip Japanese clients, and specialized capabilities in areas such as pharmaceutical logistics and heavy haulage. Those advantages matter when customers need dependable end-to-end coordination. But ordinary freight forwarding remains competitive and price-sensitive. The result is a large, credible franchise whose current profitability does not yet look like that of a premium network operator. The strategic plan, Dynamic Growth 2.0, targets 3 trillion yen of revenue by fiscal 2028, along with 150 billion yen of business profit and 10% return on equity. The intended levers are to reconstruct the Japan business, improve Europe, and build overseas scale, including the Metro supply chain acquisition in North America. The opportunity is coherent, but the plan requires a profit improvement the company has not yet demonstrated consistently. At 22.6 times forward earnings, NX trades above the report's 15 times historical reference average. A high multiple can sometimes reflect temporarily depressed earnings, and that is part of the story here, but the shares also trade at the highest displayed multiple among the listed Japanese logistics peers, despite the lowest expected return on equity in that peer group. The valuation therefore assumes much of the operational repair rather than offering a clear margin of safety. The report's author estimates a wide 3-year range, with a bearish outcome of 2,030 yen, a base case of 3,850 yen, and a bullish case of 6,134 yen. Relative to the report date share price of 5,588 yen, that represents negative 64% -31%, and +10%. These are scenarios, not forecasts, but they make the valuation debate concrete. The current price leaves limited room for merely adequate execution. To conclude, Nippon Express is a high-quality, highly liquid logistics franchise with a real global network and durable customer relationships. Its operating business appears to be recovering from a cyclical trough, while the fiscal 2025 net income shock was largely one-off. But margins remain thin, the path to the 2028 plan is demanding, and the valuation already reflects a meaningful recovery. The indicators to watch are operating margin progress, European execution, overseas integration, and delivery against the stated targets. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.